Joining us today is Alex Sell, Chief Operating Officer at the Australian Securitisation Forum, who is speaking at IIR's Basel III conference, which takes place on the 24th to 25th of March in Sydney. Hello Alex, thanks for joining us.
Thanks James.
First of all, what will be the impact of the new Basel rules on securitisation transactions?
Well, I think in Australia, which I expect is of greatest interest to the audience, the effect will be minimal. The main impact will be in relation to the requirement for due diligence to be performed on all holdings of securitisations by banks. Ordinarily, this hasn't created a problem because to the extent that banks are choosing to hold securitisations in either their banking books or their trading books or their treasury liquids books, this won't be anything new. However, the requirements certainly for very short-term held positions in the trading book, and indeed also the liquids book in the treasury book, may well create problems, given that they are only being held sometimes for a few days, either for a temporary liquidity purpose, or a temporary trading play, or a market-making function. In those circumstances, our advice is that a lot of the larger banks will have great difficulty doing that in practice. It's not something that they quarrel with in principle, but in practice, if you're only deciding to hold, say, a AAA RMBS for a day or two or a week, your ability to perform the level of due diligence required by Basel is going to be quite difficult, possibly to the point of not providing that market support in the case of a market-making function, for example. And that has sort of similarities with, for example, the short-selling experience we've had, where short-selling has certainly provided liquidity to that market. Aside from whether you like short selling or not, it has indisputably provided liquidity. And so for the same reason, in securitisation, if banks and other market makers are going to be dissuaded from doing that sort of business, there are knock-on consequences. So it's something that we are working with the regulators on, and we hope we can find a sensible outcome. Again, in Australia there is very, very limited re-securitisation taking place. The majors do have asset-backed CP conduits that they maintain on their own balance sheets that do constitute re-securitisation, certainly in terms of a strict legal read of the Basel rules. The only reason they amount to re-securitisation is because there is a interposed funding vehicle, and that then gives the impression, the complexion of being a re-securitisation, when in actual fact that is not really what Basel is trying to confront, because that interposed funding vehicle is merely a means to an end. It is not a recharacterisation of the risk, it is not a CDO squared, and so again we hope that sense will prevail on that.
And how will the increasing demand for high-quality liquid assets be affected?
I think certainly in the case of conventional off-balance sheet securitisation, this is an argument that the industry has lost. RMBS is not going to be a liquid asset under the Basel III Level 2 liquidity rules. We still live in hope that perhaps there may be a opt-out for Australia, that APRA and others are seeking to negotiate with the rest of the Basel community, given the lack of government and corporate bonds that we have, something that's well known to everybody. However, in terms of the global position, the incentive for banks to hold securitisations is much reduced from a liquidity perspective, and therefore you're ripping out a significant portion of the investor base. And of course, as we know, in terms of the so-called cliff effect, if you remove one investor base, it has a vicious circle in terms of liquidity. So other investors that aren't directly affected by those same rules will also take the view that there is a shallower pool of liquidity and therefore will be less interested in the asset class. So it's a disappointing but not unsurprising decision by Basel. Certainly in Australia, one of the things we've been pressing both the Treasury and APRA on is expanding the RBA's current repo arrangements so that RMBS is eligible, and it's not only seen as an emergency form of getting high quality liquid cash back on repo from the RBA, as is indeed already the case. So not just emergency liquidity, but actually an ongoing structural form of liquidity support. Not so that it reaches the point that the RBA has pointed out it doesn't want to become the lender of greatest convenience, and we agree with that. It shouldn't become that, and so therefore there should be disincentives to repo with the RBA, such as relatively penal haircuts on the collateral that's pledged, and also limits on the absolute amount that can be pledged by any individual institution. Similarly, as far as APRA's discrete rules are concerned, we also have recommended that RMBS be included, given that it is our RBA eligible repo collateral, and subject of course to haircuts and limits.
Will the market for securitisation continue to exist?
The short answer to that, James, I think is definitely yes. I think there's a number of dynamics at play, some short-term, some longer-term, and more structural in nature. The shorter-term factors include, say, the European sovereign debt crisis that is well underway, and the outcome of that has a knock-on effect on all debt capital markets, not just securitisation. Secondly, another short-term thing that needs to be resolved is all the regulatory uncertainty. Issuers and investors hate uncertainty, so that is creating a drag on issuance and placing a premium on price. Some of the more long-term structural considerations include the increased capital arising from Basel for holding assets on balance sheet would, generally speaking, incline banks to want to remove those assets from their balance sheet by way of securitisation. So you can see that there are factors at play that are pro-securitisation. That said, Basel also has certain measures, as does certainly the accounting rules, particularly in the United States, that are not going to necessarily encourage securitisation. In the United States, for example, it is extremely difficult under their accounting rules to get a securitisation off-balance sheet treatment. And so for those sorts of reasons, there are still structural headwinds as well as short-term headwinds. I think there's also some more medium-term issues that need to be resolved. There's a dislocation still between the pricing of securitized paper and other paper in the credit spectrum that is similar. So senior unsecured bank paper that is at best AA rated, but more typically single A or BBB plus rated, pricing inside of AAA RMBS just does not make sense on the face of it, or certainly the extent of the difference is unjustifiable on any normal fair value basis. The problem securitisation has is liquidity primarily. It has never been credit, certainly not in Australia, and that is recognised globally that the Australian product is extremely good. However, it's probably one of the least illiquid ones. So we're doing a lot of work at the Australian Securitisation Forum to improve liquidity. That means market integrity measures such as improving transparency, disclosure, price discovery, because those sorts of things will give investors more confidence in their ability to understand products, their ability to price products, but also ensuring that there aren't government or non-government initiatives that disadvantage securitisation. So, for example, government guarantees both domestically and globally on senior unsecured bank paper have crowded out RMBS, which of course doesn't enjoy a government guarantee. So, there's a lot of factors at play, and we are on balance very positive about the medium to long-term future of securitisation, but there's a lot to get done in the short term.
Alex Sell, many thanks for your time today.
Thank you.